Welcome to video T3B on timing and taxes. For those of you that mastered present value and taxes in the previous video, you might find this video a bit redundant as we're going to continue to invoke those same concepts here, but in more complex ways. But we don't really cover a lot of new territory, just more practice on more difficult transactions. In the previous video, we learned that the time value of money affects the after-tax value of our cash flows. We learned that the timing and the rate can both affect the outcome in our previous examples. This leads us to two basic tax planning tenets. Number one, we generally prefer to accelerate deductions, as we did with the property tax bill in the last video. And two, we generally prefer to defer the recognition of income. If you stop to consider those two conclusions, knowing they're not always the best strategies, they are in direct opposition to what we want as financial managers. We'd prefer to have revenue earlier and expenses later, thus maximizing our current net income. These opposing dynamics between tax and financial accounting play out frequently and are the primary cause of differences between the conservatism that underpins GAAP accounting and no such conservatism in tax accounting. Okay, example time. Mercedes is a business owner facing the exact same dilemma as our property tax individual in the previous video. Take a second and read about her now. Without even going through the math, we should be thinking, accelerate the deduction. Mercedes, pay that bill this year. But just to be explicit, I've shown you the present value computations that confirm the wisdom of accelerating deductions. Something we have glossed over up till now, but deserves our attention, is that I have totally ignored the time value of money effects on the actual pre-tax cash payment. Obviously, not having to pay the $10,000 until a later date also changes the present value of that outflow. Paying $10,000 today is not the same as paying $10,000 in 5 years. That is for certain. However, in our examples so far, we've only deferred the payment a day or two, and thus the time value of money effects are negligible. If we actually compute the present value difference on $10,000 for 5 days, we can largely wave our hands at the $7 difference. But what if we increase the payment deferral to 10 days, or 20 days, or 100 days? Additionally, what if the amount is $100,000, or $1 million, or $100 million? Changes in either the time or the amount will call for a more thorough analysis, where we consider both the time value of money on the taxed cost or savings, but also on the pre-tax cash flow itself. For those that like a tabular presentation of the Mercedes example, here it is. I like to structure time value of money problems using a framework where I place the dollars into the year in which they occur. That way, I make sure I restate everything in the present value using the correct present value factors. That is why I place the $3,000 of tax savings into year one in the deferred payment calculation, so that I apply present value factors to it, whereas all the other cash flows are assumed to occur immediately, and thus are at time zero. That includes the pre-tax payment that we just discussed. You do not have to set up the problems in this way, but it tends to be a clear and concise way to do so. Okay, just to be fair, let's change Mercedes to Dan and have him analyzing income rather than deductions. Take a second to read the example. In this case, Dan could receive the income this year or defer until next year. The few days difference makes a 1-year difference in the recognition of tax liability, and so we need to consider the time value of money. Now, the amounts are identical to Mercedes, but in this example, they are inflows, not outflows. Since we prefer inflows to be larger, Deferring the income is the better choice, and thus meets the general tax planning tenet we laid out at the start of the video: defer taxable income. I think you're ready for a more difficult example. This slide provides the pertinent facts. My suggestion is to pause the video and see if you can set up this problem to find the solution. In a few moments, I'm going to solve it for you, but I guarantee your learning will be more successful if you give this problem a go on your own first. Experience tells me most of you will fail to complete this task correctly, and that is absolutely, positively, exactly what I expect. Let's break a few eggs so we can get to the cake, shall we? Go ahead and pause now. When you come back, I'm going to use Excel to solve our problem. You can use that, or a pencil, or a pen, whatever you prefer. Welcome back. I hope you tried on your own. Either way, here's how I would solve our problem. First, I create a column for each period of cash flows. As I mentioned, that helps me ensure that I apply the proper present value factor to each set of cash flows. The rows are organized to reflect our basic understanding of after-tax cash flows. Start with pre-tax cash flows, deduct taxes to get to after-tax cash flows. Simple and something we have dealt with extensively up to now. Okay, first, let's detail out the pre-tax cash flows by year. That's as simple as copying amounts from the table provided. Now we have our pre-tax cash flows. Next, we need to compute taxes. These are largely derived from our pre-tax cash flows. However, we also get a tax deduction for depreciation, which is not a cash flow. Recall how depreciation works from financial accounting. It's an artificial recovery of the cost of property over time. So we get to take an additional deduction over our cash expenses. This provides a subtotal of taxable income for each year, which serves as our tax base. We multiply the base times the rate, and voila, taxes. Do this for each year, since the taxes will be paid in different years. Now we have after-tax cash flows by year, to which we can apply the present value factor necessary at our assumed discount rate. I've provided those factors for you. Now that each year's cash flow are stated in the same present value terms, we can add them together and get the net present value. Did you break a few eggs along the way? Probably so. But now we have the cake. Pretty sure only an accountant would describe a spreadsheet as a cake. You did it! That is the end of this video. If nothing more, I hope you enjoyed the cake I served up at the end. In our next video, we complicate our estimation models even further by considering what uncertainties exist when we forecast the tax future. I promise, no Jedi mind tricks. These are not the droids you're looking for. Thanks for watching.